So we've seen this week Canadian energy stocks hitting their first record high since 2008, driven by surging oil prices. Cenovus is one of the Canadian energy names that our guest is interested in buying. We're joined by Denis Taillefer, portfolio manager at Caldwell Investment Management. Thanks very much indeed for joining us, Denis. Maybe we could pop up a 10 or a 20-year chart for XEG or the Canadian Energy Index. So we're finally back to where we were, or getting back to where we were in 2008.
Yeah, we are, which is interesting because you look back to 2008. I think the price of oil, the commodity, hit $145 or something, right? So we're in a very different environment today. The price of oil is much lower, and interestingly enough, if you look at the last year and a half or so, the price of oil has been under pressure, and yet the energy names have done quite well. And there's a couple of factors there, but one being really that industry as a whole is much more disciplined today than it's ever been in the past. Mm-hmm. And so we're not seeing the oil companies being so aggressive in reinvesting every dollar they make, putting that back into the ground. And there's a much bigger emphasis on returning some shareholder value here, right, through dividends and share buybacks. So the balance sheets are in much better shape. The industry is much more disciplined. And any of the firms that have decent catalysts and decent growth can do that in a disciplined way. Those stocks have been rewarded quite a bit. So we like the oil space here, the sector overall, and we have good exposure to it. The oil itself seems to be somewhat maybe oversupplied in the short term, but overall we think the industry is in a very good position here as oil prices recover in the longer term.
Cenovus is one stock that you like. Tell us what attracts you to it.
So we think Cenovus is one of the larger players that has more catalysts in play. We really like the MEG acquisition they made. Obviously, the assets were very synergetic. There's quite a bit of synergies that the company has been speaking to that they can produce over the next few years, 150 million a year this year and next. 400 million in total. We think there's upside to those synergy figures. And as well, this is a company that has just a lot of decent growth prospects in front of it, really through kind of brownfield type expansions, so lower capital intensity to be able to produce some decent growth to the bottom line. They've been improving their downstream operations as well. So overall, we like it. It's got quite a few catalysts we think that will play out over the next few years. It still trades at, we think, a slight discount to some of the other major players like Suncor and CNQ. It's just starting to break out off of that 5-year chart. So we think, we think Cenovus is probably one of the better players in that larger cap space in Canada because it has more catalysts that will play out over the next few years.
Let's talk about a stock that you don't own right now, and you would, if you held it, you wouldn't be inclined to. You might hold it, but you wouldn't be inclined to buy it. Walmart. They actually I think I saw a headline. They just got overtaken by Amazon in terms of revenue. What would you be? And it is down. Investors didn't like the latest numbers from the company. What would induce you to buy Walmart?
So, the quarter was pretty good, actually. Overall, it was a good quarter. They slightly beat, top line, and on the bottom line, the margins were improving. The same-store sales metrics were solid, or at the top end, even slightly better than what the market was expecting. So it was a good quarter overall. Their guidance was somewhat conservative. They tend to be conservative, and we think it's not a bad place to be. Gives them probably a high probability of beating their quarters on a go-forward basis, which stocks tend to do well on that. They've got some strong catalysts behind what's driving that performance today. They're investing in their e-commerce platform. They have a new shopping assistant agent. That's the early numbers out of that are very encouraging. The shoppers that do use this agent, you see a pretty significant pickup in the average size of the basket. And they're also investing in their digital advertising, which is growing quickly. Their e-commerce is growing quickly. They're investing in automating their supply chain, which is really starting to see some impact on that SG&A. So as they leverage that, that will help margins as well. So we think the catalysts they have that are driving that, on top of the kind of fund flows you're seeing into more defensive stocks, are probably still going to be in play for a while. So from that perspective, we like the story. The valuation is what really kind of has us kind of step back a bit. It's trading at a very rich multiple. Again, momentum players, given the fact that some of these catalysts are still playing out, are probably more than comfortable investing here. But when we look at that overall space, we think there are other names that, from a valuation standpoint, are quite a bit more attractive here, because Walmart has had quite a good run here.
Here's another stock that you don't own, but you would be inclined to buy, Newmont Mining.
So Newmont Mining, for someone who's looking to get some gold exposure, if they're not there already, Newmont Mining is your largest gold producer in the world. They made an acquisition a few years ago. They've been optimizing their asset base. They've got a very diversified asset base. They're generating a lot of cash flow from an operation standpoint. They're doing very well. They have a new CEO in place. I think the market was really kind of looking to see what their capital allocation priorities would be on a go-forward basis. It looks like they will be accelerating or buying back more shares on a go-forward basis. So anything above and beyond the dividend, they will return to shareholders under the form of buybacks. So it's just an overall safe way to play if you want some gold exposure. We don't own Newmont. We have a few other larger players that we own in our portfolios, but we also have some smaller cap names that we think have more leverage, more catalyst to the stories that will produce more growth on a go-forward basis. But there's, Newmont's kind of firing on all cylinders here, and it's kind of a safe way to get exposure to that gold market.
I'm just checking these numbers here for Amazon and Walmart. So apparently Amazon hit $717 billion in sales last year. Walmart, which was the world leader, was slightly below $713 billion. However, almost $130 billion in those sales at Amazon came from web services. So it's kind of apples and oranges. Yeah. Thank you very much, Denis. I really appreciate it.
Thanks for having me, Andrew.
Denis Taillefer, Portfolio Manager at Caldwell Investment Management.